Welcome to the deep dive video update. This is a video that I do once a week where I look at a couple of different things. First of all, there are charts that are unique just to this video, but they're more for informational purposes. The other part of this video are charts that come and go in and out of the videos that I do every day. Some of these I actually used in the past week, but I haven't used them in the last few videos, so I put them back into this video. And the reason why I call this a deep dive video is because we have to look a little bit deeper to see if we're getting some insight or clues as to what's happening in the market. This is being prepared for Monday, March 3rd. The first one is for information. This is a long range look at the VIX. The VIX is a fear gauge. When the VIX is going up, that means stocks are going down. So as this goes up, that means there's more and more fear. And when we're in more negative market climates, the VIX goes into a higher range. When we're in a more positive market environment, the VIX goes down into a lower range. And we're still in a lower range as we go through 2024 and into 2025. We're picking up a little bit here as the market's been under pressure and we've lost a lot of momentum so far in 2025, but we haven't really switched longer term up to a higher VIX range. If you remember back from late 2021 into 2022, that was a cyclical bear market. We were going down at that point. Well, during that time, the VIX switched to a higher range. We finally bottomed, and then in 2023 and into 2024, things have been really positive, and that's when we go down into this lower range. And so we're not really seeing any changes. This is long term, so it takes a while for this to develop. But this just shows us that overall the market continues to be positive since it's in a lower range for the VIX. This is another study with the VIX where I do a correlation between the VIX and the S&P 500. We only pay attention to this chart when we get above the dashed line. We're getting a very low reading right now, so we're not really getting any insight from this chart. Then we look at the VIX, and then there's a thing called the VVIX, or the volatility of the VIX, just to see how fast is the VIX actually moving. And we're pretty much flatlined right now, even though with the declines we saw this past week, it's picking up a little bit. But we're not seeing any real move either up or down. And in a general sense, when this ratio is going up, that means the VIX is outperforming the indicator of the VIX, and that is when the market's more negative. And then we finally hit a bottom and started to go up, and this started to come down. Well, really, for the last couple of years now, we haven't really seen a lot of conviction with this gauge. Then we look at the volatility of stocks measured by the VIX and the volatility of bonds measured by the MOVE index. And this red line is going up a little bit as we're seeing a bit of volatility creeping in to the stock market and the bond market. That's really what I follow here. And so we're just seeing it picking up a little bit, but it's not showing all that much conviction. We're not really moving up quickly or going down quickly at the present time. This is more for information too. Going back to the low that was set in October 2022, even with the recent declines, we're still up over 70% from that low. And then we hit another major low in October 2023, and we're up over 45% since that low. Then stockcharts.com every day has technical alerts, and these apply to indexes, sectors, and even Canada is included in there. And I go through the alerts in the daily videos. Well, this chart here shows the alerts for the entire week. And we start at the bottom, that was Monday, and the last one was generated on Friday. And when we see a lot of red, that's negative. When we see a lot of green here, blue, whatever color you see, that's more positive. And we had a nice little bounce up on Friday, so we saw more positive signals. Thursday was a pretty significant down day, so we saw a lot of red. And then we've been seeing some deterioration going on here throughout the week as the market has been under pressure lately. Then what I also do is on a scale of 0 to 100, there are 6 indexes that I follow, and stockcharts.com tries to remove all emotion by just giving you a score based on what the technical analysis indicators are doing. And then I rank them from the best looking index right now all the way down to the worst. In first place is the Dow. Now, this has been lagging behind for much of 2024 and even into 2025, but it held up better. And throughout the week, as the market was under pressure, the Dow was still positive year to date, where even the S&P was starting to go negative if you measure back to the beginning of 2025. This is not a strong score. When we're above 90, that's when the indexes are really looking strong. But even in the face of what we've been dealing with, this is still the best looking index right now, coming in at 76.9. Then in second place is the SPY, and that's holding up a little bit better. Now we have the NASDAQ 100, that's mainly tech. Well, the S&P has those same stocks that are tech, but it's 503 stocks and it's more spread out. There's some value stocks. There's stocks that have been around a long time that maybe don't move as much, but when we're going down, they hold up a little bit better. And that's why this is coming in second place, because we're seeing some of the rest of the S&P showing some improvement while the big stocks have been under pressure lately. And the S&P is coming in at 67.3. Again, not a great score, but still coming in second place right now. Then we have the QQQs, which when we're really going up and the market's looking positive, this is usually in first place every time. Well, it's falling under 50 right now, as this index has been under pressure as well at 49.8. Then I also just recently added the Nasdaq Composite, and this is the broad index for the Nasdaq, where the Nasdaq 100 is more focused on the bigger stocks. And this had been performing quite well and looking pretty strong, but lately you can see over here where it's really been falling down lately, and it's coming in with a score of 38.8. Then the mid caps, which just haven't been performing well. There was hope at the end of 2024, going into 2025, that these stocks might see some favor. Nah, they're coming in at 20.4. Now, what's really disappointing is IWM. This is the small cap ETF. And we didn't really see the January effect, the Santa Claus rally, any of those things. And the small caps are just not looking very good right now, coming in at 11.4. Now, some of this could be because interest rates have been going up, and smaller companies and even mid-cap companies, they have to borrow more money. And with interest rates being up, that means they have to pay more to borrow that money, and that can really affect their bottom line. And so we're just not seeing the profits coming through to these companies, or the bigger companies. They still have to borrow money too, but they're bigger, and so they can spread this out and absorb these costs a little bit better. Then I have a short-term rainbow, and this goes from 10 periods, a simple moving average, up to a 50 period simple moving average. And we've been really solid here through 2024 with some pullbacks along the way. And then also in 2025, we've really slowed down. The momentum has really been lost to this point, and we're actually turning more negative, and we dropped below the rainbow. The longer we stay below this rainbow, the more these lines are going to roll over and possibly turn even more negative. So the short-term trend is now negative. Now I measure that with a 20 period moving average. Then I plot these other moving averages around that to give it a little bit more context. And when we're below the rainbow, yeah, it's just showing that in the short term, we're under pressure and actually negative right now. Then I also keep an eye on what's called the advanced decline ratio. Now I show a chart in every daily video, but that's just focused on price. This chart also uses volume in its calculation. And we're a little bit above zero here based on price and volume. So we've been pulling back a little bit, but this is still hanging on to being positive at this time. And another intermediate term rainbow. This goes from 50 periods up to 100 periods, and I use the 50 period moving average as the base of the intermediate term trend. And we're even falling below this rainbow now. We lost the 50-day moving average recently, and we went all the way down to the 100-day moving average, which we're still holding on to for right now, even though it's acting as overhead resistance at this time. Well, we tried to go back up a few times in the last week, and the 50 period moving average is acting as overhead resistance. So even though the lines haven't really started to roll over yet, it just shows that the intermediate term trend has been vulnerable lately to actually turning down. Then this is one thing that I was watching pretty close, but I didn't end up using it in the daily video. This measures the distance from where we're at with the S&P versus the 200 period simple moving average. And we were coming down. We were under 3% above the 200-day moving average. Now, the 200-day moving average is the long-term trend. And if we see more weakness going forward from here, we may go down and actually test that. And if we drop below it, that's going to turn things more negative. But so far, we're still above it and it's holding up. And as long as we're above the 200-day moving average, the line itself still continues to go up. Then I just do some basic measurements here, and I have to eyeball this, so it may not be exactly correct. But just measuring from the October 2023 low up until Friday's close, we get a percentage return here, up a little bit over 30%. And then another thing that I measure is when we hit a high and then we start to go down, I keep track of the different percentage loss that we're seeing at that point. If you remember back to last summer, we fell almost 10% before the market finally said, okay, we've gone down enough. We're going to go back in and take the market higher. Well, then in December, we hit a high in early December, and then we started to fall down. That was a little bit over 5%, and that's what we just call a pullback. If it starts to go over 5%, closer to the 10%, then we're looking at something a little bit more severe. And if we get over 10%, that's what we call a correction. Well, we're keeping an eye on this because we set a couple of recent all-time highs, and now we've been coming back down. And to this low, we're still at about the 5% level. So this is just normal volatility that we see in the market to this point. But we watch this because this could morph into just normal pullbacks into something more severe. And that's why I watch this on a percentage basis to see, okay, at some point, is the smart money going to come in and start buying? Then this is a momentum oscillator that doesn't give us very many signals, even though it gyrates like crazy from day to day. This is similar to a regular RSI where we look at extreme positive or negative readings. We're not getting one right now. And even with the declines that we've been seeing, we haven't really moved all that much to the upside or downside with this indicator. And then I did show this a couple of times in the past week because these are anchored moving averages, which vary from regular moving averages because they project forward. And I drew an anchored moving average back to this low right here, and we actually broke below that. Here's another low where we did break below that. But we're finding, see this more significant low that we set last August? Well, that's the black line that you see here. And for right now, we are finding some support coming up off of that moving average. Now, if we could keep going up, that we could get a nice little bounce out of this. But if we start to break below these other anchored moving averages, obviously that's going to mean that things are turning more negative. Then we keep an eye on the S&P 100, which are the biggest stocks that make up the S&P 500, and both have been under pressure lately. And the mass index not generating a signal right now. We only pay attention to this chart when it gets to the red dashed line and the blue line. Now we're coming up, so I'll keep an eye on this, but we're not generating a signal currently. Same thing with the praying bottom fisher. It hasn't crossed back above the red line yet, even though it's starting to turn up. If this crosses back above and starts to rise here, I will start including this in the daily video again. Then we have a long-term rainbow going from 50 periods up to 250 periods. And even though we're coming down into the rainbow, we haven't been here for very long. So the lines haven't started to roll over yet. This just means that the long-term trend, although looking a little bit vulnerable, it's still holding up for right now. This is a long-term oscillator called a special K, rolling over a little bit, but we're still above the red line here. And we don't get very many signals from this because it's very long term. That's why I don't show this chart. I just look at it, and if we start to see a cross, either above or below the red line, then that's when I'll show it in the video. And this is longer term, and this measures the 10-day average of the highs and lows in the S&P. We're still above zero, even with the pullback that we've been seeing here. And so we're still positive. But if we start to come down and drop below 50, that's going to turn this chart more negative. And we look at a weekly chart of the S&P on top. That's, of course, the US. And then the German DAX, which is the biggest stock market in the EU. And we're seeing that the US stocks are just kind of going sideways right now and even retreating a bit, where there's been more strength in the German market lately. And that's why we're seeing this correlation dropping off right now. And this kind of comes and goes in and out of the daily video. This is a 20 period simple moving average of the open, high, low, and close, which creates its own little mini rainbow. Well, since we dropped below the rainbow and the lines are starting to roll over, that's turning things more negative. Then, if we do keep going down, going back to the all-time high that was set recently, these are Fibonacci retracement levels, which can often provide support if we are declining. And even though we have been going down, we're not really that close to this first fib retracement level. So until we get to that point, I haven't been showing this chart. And we look at the Vixen, you gotta love that name. That's the volatility measure for the NASDAQ 100, where I mainly focus on the VIX, which is the volatility for the S&P 500. And so I do keep an eye on this, and we're seeing volatility picking up here. It's well above 20, but it's not as insightful for the kind of analysis that I do. So I mainly focus around the VIX and have a lot of studies attached to that. Then we look at the S&P on top, and then we do a ratio of growth versus value here, the QQQs to the diamonds. This is the Dow. And we see that there's a pretty high correlation between the two. Now, they could both be going up or down, but they're usually doing it together. Then we want to keep an eye on the Dow and the transports, which the red line are the transports, and they've been really underperforming and have been for quite a while. And the Dow, which is the black line, it's one of the better looking indexes currently. And we want to keep an eye on the financial sector. That's the bigger picture. Then one part of the financial sector is the bank ETF. And we dropped down below the 50-day moving average, and we're still in a longer term uptrend, but we're trying to get back above this 50-day moving average. Financials were actually really strong in Friday's session, and they've been holding up fairly well, and that's good. That's positive for the market. It just means that the whole financial sector is not falling apart right now like we saw during the great financial crisis. So we just want to keep an eye on this, but it's holding up for the most part. Then we look at another ratio between regional banks, which are smaller banks, and then the financial sector, and they're underperforming here. And now the rise in interest rates, this makes smaller banks more vulnerable because they're going to have to refinance a lot of stuff at higher interest rates. And this is when we saw this big drop here, that's when Silicon Valley Bank went crazy and Republic Bank, and then we dropped again when New York Community Bank went crazy. We're just keeping an eye on this just to see if things are looking okay here. And even though this ratio is coming down and we might be seeing a death cross here with this ratio compared to the financial sector, it's not really falling apart all that much, even though it has seen some weakness lately. This is just for information. This is a long-term rate of change chart where we look at the close on Friday and then go back 250 trading days before that. And we're declining as we've been losing momentum longer term. And we're also going down with this other 250-day rate of change chart where we came above this blue line. That was showing good long-term strength. And now we're starting to come back down. So even though the long-term trend is positive, it has slowed down a bit lately. Then we keep an eye on bonds, and I look at a ratio between cash, which is 1 to 3 month T-bills, and then 3 to 7 year bonds. Now we were getting some fear here because when this is going up, that means there's uncertainty about interest rates and inflation. Well, you can see now that it's actually been coming down. The ratio is still in an uptrend. The blue line's above the red line here, but this has been falling back underneath the 200 period moving average. So according to the market, maybe some of the fears that we're seeing are subsiding when we look at the short term as far as interest rates. And we go with TIPS, Treasury Inflation Protected Securities, and compare them with 3 to 7 year bonds. When interest rates are going up and there are concerns about inflation, TIPS outperform 3 to 7 year bonds, and we see this ratio going up. And in 2025 so far, there have been an increase in inflation concerns. So we'll keep an eye on this. Now, this is still in a downtrend. It can take a while for these moving averages to cross. Now, if the blue line crosses above the red line, that means that'll be a golden cross, and it means that on a trending basis, tips are outperforming 3 to 7 year bonds. And that would be a little bit of a concern. If this ratio was to come back down, that means the market is not as concerned about inflation. And we look even further out. Now, this was getting to be a concern too. Tips to 7 to 10 year bonds. This had been going up as interest rates and inflation fears were going up. And this goes all the way back to last fall. But lately, this has been really coming down as interest rates have been coming down. But stocks have been under pressure as well. But if this could continue to fall, that would be more positive for the market. And we look at the long-term bond ETF, which here is in blue, and that lately that's been going up. And the S&P in red, which had been going down, but it did bounce on Friday. And then we look at the correlation. The longer-term correlation is actually getting weaker between are they moving together or are they moving in opposite directions? And with the short-term correlation, they are moving in opposite directions because we're getting a very low correlation here. So as bond prices have been going up, the S&P has been coming down. That's where we're getting a pretty low short-term reading. That same basic approach here, when we look at the QQQs, which is the NASDAQ 100 to the long-term bond ETF, on the previous chart it was in blue, here it's in red. We're pretty much neutral with the correlation right now. We've been more or less neutral for most of 2025 so far. And then we look at the rate of the 10-year bond in the US and subtract the German 10-year rate. And because US rates are higher, that gives us an answer above the red line. And then we plot the US dollar index down here, and we see that even though it's weakening a little bit, there's a pretty high correlation between the top chart and the middle chart. And this shows us the interplay between interest rates, not only in the US, but internationally, and currencies as well. Now, if this continues to fall out of the blue area, that might mean something weird is going on. But as long as we do stay in this blue area overall, that's pretty much normal. And we want to keep an eye on the 2 year Treasury yield. This is shorter term, not really moving all that much now. It had been going up, now it's starting to come down. If this continues to fall, that may be more positive for the S&P 500. And we do a really crazy comparison here. Euro stocks, or the Eurozone ETF, and then US bonds, 3 to 7 years. And stocks in Europe have been doing pretty well. Now they're bouncing down a little bit here. They're retracing, but overall, European stocks, that's been where a lot of the strength has been seen so far in 2025. We don't know if that's going to continue, but it's been that way for the most part up to this point. Then we have possible positive scenarios. This is a number of different studies that we look at. And I use some of these in the videos every day, but these are the videos that I don't show all that much. What you see here is a percent of stocks in the S&P above their 200-day simple moving average. Now I have another chart that measures the same thing, but I look at it in a bit of a different way and it's set up a little bit differently. The takeaway from this is we're not getting an extreme positive or negative reading, but we are above 50. So even though we've been coming down, we're seeing some weakness here, but we're still positive longer term. And we use that same basic approach with those stocks in the S&P above their 50-day moving average. And this had actually crossed down below 50. That's kind of the line in the sand between positive and negative. Well, in Friday's session with the bounce up that we saw, we're just barely back above 50 right now. We're not getting an extreme positive or negative reading currently. And then to give us a little bit broader context, I look at the mid caps where they're under a lot of weakness. They're coming in at 38 right now. And so we're well below that 50 level. And even worse are the small caps coming in at 31.33 as these stocks have been under a lot of pressure lately. So thank you. I hope you found this helpful. Please feel free to check out the other videos that I post. Have a great weekend, and I will talk to you in the next video.